So on today's session, we're going to be talking about how to really identify key levels in the market where you can buy and sell with confidence. Because far too often, what traders are doing is they're drawing way too much information on their charts. And then this becomes very confusing and messy. Now, the majority of us, when we started learning trading, we learned to draw our support and resistance levels from our high time frames, looking for areas on the market where prices reacted to before. Now, I'm not saying what I'm doing right now is 100% perfect, but what I do know is that this is an illustration of how traders draw their support and resistance levels. And what can end up happening is by the time you get these levels in from your higher time frames and you scale down to your lower time frames to look for your patterns and your entries, it becomes far too confusing. So on today's session, we're going to iron this out. We're going to identify key levels in the market where price has reacted to and shown a aggressive move from that level so that you can identify tradable opportunities by the time you get down to your lower time frames. So without further ado, let's take a look at this first example on CAD JPY. Now, when we're looking at this, what I want you to understand is we're not going to be gathering any evidence from the left. We're going to just be simply identifying an area in the market where price has come to, has shown you no signs of why it has rallied from that area, and then identify what happens when price comes back to it. Now, it sounds simple, but there are a few factors that we have to consider before we do this. So if we look at this example, we can see here in and around this area, price has come to and immediately has rallied to the downside. Now, there's no supporting evidence to the left to help us to identify why this has happened. But what this could mean is that this is an area where sellers are sitting. So what we can do with this information is we can take a simple line from where this reaction has happened to in the past, and we can drag it to the right. Now, we never know when price is going to come back to this level, but what we do know is that there is a high chance in the future that if price gets back to this level, there may be a reaction. Now, is this enough to support why we should be selling? Absolutely not. But what we can now start to do is delve deeper into the behavior of how prices come back to this level. So if we analyze this market structure off the bat, what we can see is over the past couple of weeks, price action was pushing to the upside. Price was making higher lows, higher highs, and higher lows. Now, this is indicating a strong bullish sentiment in the market. Off of the back of those higher lows and higher highs, we had a very strong bullish candle to the upside. Now, we don't know that the market's going to reverse, and we don't know if the market's going to turn around. But what we can now start to gather is evidence and confirmation to identify what is happening at that level. So based on the information that we have here, which is bullish structure technically, with the higher highs and higher lows, we now have a strong bullish candle into this previous structure, and then immediately look what we have. We have a depletion of that bullish pressure in the market at this significant level where prices rallied from before. So how do we work with this data? Well, firstly, we identify where that rally happened before in the past, which is this information. We see how price is coming back to this level in terms of the structure, which is a bullish structure, bullish behavior, and then we start to identify how price is reacting at that level, which is a depletion in that bullish pressure, which is evident of two daily candles showing evidence that it's failing to break above this structure. Now, what we can now start to do is work out when the momentum shift happens. And how do we do that? Well, we can just simply wait for a strong bearish candle to push to the downside. This is now giving us evidence that the sells that were sitting in this area in the past have identified that they have stepped back into the markets, and they're showing true confirmation of this with this bearish candle. So how do we trade this? Well, you simply scale down using your strategy or the patterns that you trade to your lower time frames, and now you can start looking for tradable opportunities. They could be simple double tops on the lower time frames. They could be simple lower highs on the lower time frames. They could be head and shoulder patterns. They can be your breakouts. They can be your channel breakouts. They can be whatever it is you trade. And what you need to understand is that once you've gathered this information, which is very, very important, you can now start to take advantage of the behavior that happens after. you have 1, 2, 3, 4, 5, 6 days that we can see on the screen right now worth of bearish sentiment in the market, and all these daily candles will give you an opportunity to sell as long as you can use the correlation from the high time frame back down to your lower time frames, looking for those patterns and those processes. Now let's take another example right here so that we know that what we're talking about is true. We have a level in the market here where price has come to in the past, not using any data right here to the left, and we can see that off of the back of this strong bearish pressured market, we had a very strong rally to the upside. So we can take that information, but remember, we're not just impulsively jumping into the markets, and we can draw our level like this. Now notice the difference here with this scenario. We do have that strong bearish candle back into a level in the market where a rally has happened before, but look at the example that we had above. The difference here is we do not have evidence of depletion in this market. As you can clearly see here, we have the depletion, but here we do not have the depletion, which clearly indicates to us that no matter what happens, we are not looking for buys unless we get that behavioral pattern, which is this depletion. So a very simple example, very powerful example, and this can be adapted to any strategy you trade, regardless whether you're a support and resistance trader, a supply demand trader, whether you trade structure based on lower highs, higher lows, Fibonacci's. I really don't care what it is you trade. It can be traded across the board. So let's take a look at another example right here. So here we have an example on Aussie dollar JPY. Now let's take a look at this process again. We're looking for an area in the market where prices come to with no data to the left to indicate why price will then rally from this level. And what we're going to do is identify how much this market has rallied off of the back of a strong uptrend. So this becomes a significant area in the market. Once we gather this information, we can then join the dots from right to the left, and we can start to see how price reacts around this level when it comes back to it. Now, again, we never know when it's going to come back to it, but that's what our plan will be. Now, a lot of traders will see this and say to themselves, well, this is very strong bullish market structure. And now look, I'm starting to see in and around this level, the bears stepping into the markets. And because of fear of missing out, what they will eventually do is they'll take this data and they'll draw levels like this and start to say to themselves, well, now this is starting to look like price is failing to push up. This looks like a potential lower high, and this looks like an area where price may react to and continue to rally off of the back of past history, which is this information here. But what you must understand is that we're not looking to jump into the markets because we think that there's going to be reaction. We need to wait for price to come back to that level to give us that reaction, so that we can avoid being the traders that jump into the markets and get stopped out and then see the market come back to our level and rally. So let's gather this information. We see a level in the market where prices come to with no data to the left to indicate why there was a rally. This is indicating sellers must be in the market in and around this area, and we've identified this. Now what we can do is we can wait patiently for the market to come back to this level. Now this scenario is slightly different because we don't have strong bullish pressure coming back into this structure, but what we do have is a significant reaction from this level where we can see on this day the bulls were pushing really strong into this level off of the back of this uptrend, and we had a strong reaction. Now does this mean that we're going to sell the market straight away? Well, absolutely not. Because if we decide to take this trade based on a pin bar, technically what that means for us is we're going to have our entry below this level here and our stop loss above this level here. And then what that means for us is the range of our potential target becomes increasingly big. Now, granted, this would have hit take profit because we can see the data to the right, but what we want to do is minimize that. So how do we do this? We're going to wait for a significant reaction, which is this evidence here, off of the back of a level in the market where prices rallied before, and we're going to wait for the momentum shift. Once we have this momentum shift, then what we can start to do is work off of this data, using the correlation with our lower time frames to look for tradable opportunities. And as you can see here, we have 1, 2, 3, 4, 5, 6 days worth of information that we can take to our lower time frames and look for those patterns we mentioned in the beginning. So please be mindful, and this is very important, that you wait for price to come back to a key level where price has significantly shown a reaction to in the past, but with no data to the left, so that we can identify where the sell orders may be. Then we wait for the momentum shift in the market so that we can identify that the bears have actually taken over, and then we can take advantage of the days where this trend will continue to go down. And this is very important. It's pretty simple and it's very, very effective. And if you learn to do this in your trading, you will find that you'll be able to keep it super, super simple, yet very, very effective and powerful. And you will start to see the changes in your results going from losses and break-even trades to more consistent profits and consistency in your ability to trade. So I hope you enjoyed that lesson. Very short, very simple, but to the point, and that's how I like to keep it. And I advise you guys to give it a go. Leave a comment in the comments. Let me know how it goes for you. And as always say, if you enjoy this video, please drop us a like, subscribe, and until next time, take care.